You were listening to chartingwealth.com for Wednesday, the 9th of May, 2018. We see stocks and bonds are down for the day. Gold is flat. Let's jump right into the S&P 500 on the weekly chart. So far, we're only 2 days into this weekly candle. Remember, weekly candles are 5-day candles. And what we see going on here into day 2 through Tuesday, we see that we have a green open box candle. Again, not much of an up candle, but it is a bit of an up candle. Shows us that we're still sliding sideways. We look at the price percent oscillator. It's pretty much tracking sideways. Derivative oscillators losing downward momentum, of course, with what we see so far as this green open box candle. Now, for the day, the S&P 500 down just a little bit, 0.01%, so 0.1%. If we look at the 2-day chart, what do we see? Well, we see the 2-day chart, we have the blue price percent oscillator still bouncing off the red signal line and moving up. We have closed out this latest 2-day candle, and it is a green open box candle after 2 prior red down candles. Again, we're just seeing sideways slippage, but tending up a little bit as far as the 2-day chart goes. And remember, the 2-day chart rotated over going up back on the 16th of April. And then as we look at and we see the price percent oscillator heading up and the derivative oscillator heading up, we see the 4-hour chart where things topped out back on the morning and afternoon of Monday the 7th, and then sort of slid sideways and down since then. So again, price percent oscillator still going up. That sideways sliding down is as far as the Heikin-Ashi candlesticks go. Remember, Heikin-Ashi means average pace in Japanese. Some great teachings at our website and at our YouTube channel on Heikin-Ashi candlesticks. I believe we're up to like 70,000 views on that one video, our biggest video ever. We see that the derivative oscillator is gaining upward momentum. Price percent oscillator headed up, even as we watch price sliding sideways. So we'll continue to keep our eye on the S&P 500. And again, keep in mind when we look at the big chart, remember the big chart rules, still in a confirmed down move, although a lot of sideways slippage. So all things being equal, the market tends to move in the direction of the largest chart until that changes. Changes are always precipitated by the 2-day chart changing direction. That has happened, but again, we have to see that weekly crossover going up. Derivative oscillators continuing to lose downward momentum, so we'll continue to watch and see what we see. When a crossover occurs, we will let you know, but it has been long in the tooth in coming if that's what's going to happen. Might be more likely that we see the 2-day rotate over going down, perhaps. But again, we're not going to make judgments on that. We're not going to try to forecast it. We're going to trend follow. And that is when we have clear trends, we follow them. We don't have a clear trend right now, so we are not investing in the S&P 500, but we are tracking it on a daily basis, watching it, filling out our daily market worksheets every day, weekly market worksheet once a week, and every time we do a practice trade, we fill out the trade worksheet. Don't forget, we have our trader journals for sale. You can, of course, check out in the show notes and at chartingwealth.com in the daily market review. There are links where you can buy your trader journals. Now you can save 15% by buying an entire year's worth. Enough advertising. Let's jump back into the Qs. What's the Nasdaq 100 doing? Well, as we look at the weekly chart, we see that so far in the week, it is another green up candle. We see more upward movement on the price percent oscillator than we do on the Qs than we do on the S&P 500. Derivative oscillator losing downward momentum. A nice size green up candle so far for the week, even though we are down for the day 0.14%. Remember, Heikin-Ashi candlesticks are generated different than the open, high, close, and low of a standard candlestick. That's why we want you to learn what they're about and take that training at the website. We look at the 2-day chart. We see that latest 2-day candle has closed, and it's a nice up candle, the second up candle in a row after we had the 2-day vertical crossover back on the 2-day candle ending on Friday the 4th. And we see that price movement is, of course, above the 2-day trend line, derivative oscillator gaining momentum, price percent oscillator heading up. We look at the 4-hour chart. What do we see? Well, we see that it too appears to have topped off like we saw in the S&P 500 back on the 7th, and of course sliding sideways since then. Now we'll continue to keep our eye on things, see what this 4-hour chart is going to do, and see when we're going to have a setup with both the weekly chart and the 2-day chart moving in the same direction. Not happening right now, but it may be happening by the end of the week. Perhaps we'll have a crossover going up on that weekly chart. Don't know yet. Lots of indecision in the market. We'll continue to watch things and keep you posted. What's going on TLT, the 20-year bonds? We still have a laminated, pretty much. That means that the blue price percent oscillator and the red signal line are sliding sideways. We're going into our 3rd week of that. And we look at price movement, we can see that we had 2 down weeks, the week ending the 20th of April and then the 27th, and then a sideways slide the week ending the 4th, and so far over the current week. We do have a red closed box down candle with a wick, but it's a small one. Remember, the 2-day chart is heading down. The weekly chart just barely up. Maybe it'll end the week, maybe crossing over, going down and give us the opportunity to do something. What do we see on the 2-day chart? Well, it's sliding sideways also, and the latest 2-day candle is a red doji, meaning lots of indecision, tending down. We'll continue to keep our eye on things and see what we see there. Again, just lots of indecision. We see indecision in the stocks, and we see indecision in the bond world. Remember, typically the way things have worked in the past, that when the stock market's going up, bonds typically go down. Why? Because the bond market is a safe place for money to flee when the stock market's not doing well. So when the stock market's not doing well, bonds do well. That's typically how things have worked over the years. Not always that way. And of course, what do we see going on right now? We see indecision both in bonds and in stocks, as one might expect, until things shake out. So what do? We keep our money close. We're not out there speculating. We are trend following, and we don't have a solid trend. We don't trade. So we see the derivative oscillator losing downward momentum, price percent oscillator sliding sideways. What do we see on the 4-hour chart? We see that again, lots of sideways sliding there. We had a crossover going up on the afternoon of the 27th of April, went up for another day, and since that time period, since about the 30th, things have just been sliding sideways. So we'll continue to watch, and when we get a trend, we will look to do a practice trade. We don't have a definable trend at the moment on TLT. Let's take a look at gold. What's going on there? Well, of course, gold crossed over going down all the way back on the 16th of March, then was followed by some up movements, and over 2 prior weeks, the week ending the 27th of April and the 4th of May, we had strong down movement. So far over the course of this past week, we have up movement, a green solid candle, again, not the open box green candle, which is typically the strongest. We have a solid green candle with a down wick. We've broken through our 2-day trend line, but as we look at the weekly chart, it is gaining momentum on the derivative oscillator and the price percent oscillator heading down. We look at the 2-day chart. What do we see? The 2-day chart's also in a confirmed down move. It's lost some of that downward momentum. Derivative oscillators lost some of its downward momentum. Price percent oscillator not heading down at the same strong angle. And the latest 2-day candle, we have a red spinning top, which means indecision tending down. Now, the 2-day and the weekly are both in confirmed down moves. We look at the 4-hour chart. What's going on there? Well, it's in a pullback. And as we talked about yesterday, we're waiting to see if there's going to be a rotation over and a move down, a crossover going down. That would be a potential jumping in point for a short trade in gold. That is either getting into an inverse gold fund, which typically are not very liquid and difficult to get into, or purchasing a put in gold and seeing how that goes. Now again, Not my favorite time of year to trade, but if we have a discernible crossover going down on the 4-hour chart and it makes sense, then of course we might look at doing a virtual trade, a virtual put on gold, and seeing how that works out for us if it sets up and goes that way. So far it hasn't, but that pullback is underway, and if it's not strong enough that it rotates the 2-day chart over going up, then of course once that 4-hour chart rotates over going down, we want to look and jump into that. So check the charts tomorrow at noon and then see how the afternoon is shaping up. We'll update you tomorrow as we did today, as we said we would do yesterday, on what's happening with this pullback in gold. We see really a sideways slide. The derivative oscillator is flat. The price percent oscillator still heading up. We'll continue to keep our eye on things, and we'll keep you posted. Folks, that's where we are as we end the day on Tuesday. I know this is the toughest time of year to trade. That adage, sell in May and go away, didn't come about for no reason. But you need to stick with it. You need to keep practicing. And again, how do you get to Carnegie Hall? Practice. How do you get great as a chartist and a trader? Practice. Keep practicing, my friends. God bless. All the best. Hang in there. All the best from the whole team here at Charting Wealth World Headquarters.